Thanks, Marty. I'm very honored to be in this last panel. Marty always throws these really great conferences, and I think, just today we talked about healthcare, tumor, AI, robotics, and our most recent, our last panel was on NFT. So super interesting. Just to bring everything back, we have 4 great family offices, and to put everyone on the spot, I thought we would go around introducing everyone. But also, I think the really interesting topic is I asked the panelists to pick 3 types of investments or areas that you're super interested in, or if you don't want to answer that, 3 that you definitely want to stay away from right now and the reasons why. So that's going to be the focus of this panel, just to prep everyone. So let's go around and introduce everyone. Sandra, ladies first. Do you want to go first?
Oh, goodness, absolutely. Hi, so I am Sandra Malek, and I am co-CIO of my own family office, along with my husband, Chauncey F. Lufkin. He's from the DLJ family, Donaldson Lufkin Generet. So we've been a family office now for about 10 years, and we are very, very active. We do invest in funds, and sometimes we do co-investment alongside our fund managers. We lean on their due diligence, but we also do direct investing as well. And we are a family office based here in the Palm Beach area.
Wonderful area. David, I'm just going alphabetical now. David, do you want to go next?
Hi, I'm David Hendren. I'm actually sitting in for my colleague, Christian Malek, who was unable to attend. I'm part of a Swiss-based group called Novastone Capital Advisors. Novastone has an entrepreneurship through acquisition program that is a cornerstone of its strategy. I'm happy to speak separately about observation of direct investment by family offices in a variety of other areas, but we'll be happy to describe the entrepreneurship through acquisition program a little bit as things go on.
And Patrick?
Sorry, I was on mute there. So I work for a firm called Manhattan West. We are a multifamily office that spun out of JP Morgan about 5 years ago. And I organically developed our private equity arm just through demand of our families. We work with a lot of entertainers and athletes, and we're based in LA. And I lead the co-investment and direct investment platforms for our families and for our co-investment families.
And last but not least, Russell. Russell, I've already heard about your really great track record through the grapevine, so really excited to have you on the panel.
Well, thank you for that. Nice to be on the panel. Nice to see some old friends on the call. Sandra, nice to see you, and to meet some new friends as well. I'm 4th generation Anglo-Brazilian family, single family office. I guess our core business over the last 4 generations has been real estate. I've been now 20 years in venture capital, private equity, private investments. Was a partner in Latin America's oldest venture capital private equity firm. I do direct investment seeds, Series A and B, and I also invest in funds domestically and internationally. And again, generally, we'll do our own real estate deals ourselves. Don't generally invest in funds on the real estate side, but I have done. And then on the venture capital and the private equity, we do invest in funds, we do co-investments, and we do direct as well. So a little bit of everything.
I'll also say 2 sentences about myself. I'm a partner at IndieBio. We're the world's largest life sciences accelerator. So we tend to be the first check-in. Really increased our check size to $500,000, and the therapeutics track is $2.5 million. So a huge chunk of capital to help entrepreneurs get to IND stage, even phase 1. Prior to that, I spent 18 years on Wall Street. So I actually managed a hedge fund that was investing in tech stocks via the M&A strategy. So very familiar with that side of the business. I actually spent 5 years at JP Morgan as well. So Pat and I intersected a little bit there. I spent my analyst years at Goldman and then 4 different buy-side shops, eventually getting promoted to a portfolio manager at a hedge fund. So love both the private side and the public side. So I have to say that I love family offices because you guys are definitely the most innovative crowd and you don't get enough credit because I think a lot of these deals are not publicized. And so I think, I really need to give credit where credit is due. And from my experience, some of the early investors, whether, it's in early stage VC or, healthcare deals, or even some of the, crypto deals, they were actually from family offices and select endowments. So you guys are definitely the smartest crowd. And I'm just honored to be on this panel with you. So let's start with, everyone on the panel gets one pick. What's your favorite pick investment? Or what's your most hated at the time? Sandra, do you want to start again?
Sounds
So,
wonderful.
so is it my favorite or the most what? Oh, most
Well,
hated.
Yeah,
Oh, okay.
you can either pick your most loved or most hated at the current
Oh,
moment.
good. Okay. So, a little bit of background. I ran Entrepreneur of the Year when I was at Merrill. I was on the IPO desk. We did like an infusion of capital with one of the winners, and then we took him public. That was Michael Dell. So I've been in venture for 30 years now. So that was a great background to, now be co-CIO of our family office. So when we were, I have to tell you, in our younger days, we were doing a lot of pre-seed, what people would call the venture studio model, helping to co-found a company with a scientist. So we did a whole lot of that. But as you grow older, you really tend to kind of like sometimes the last money in before exit or IPO. So we have done a barbell approach very, very successfully. I have to say one of the last deals that we just did was one of my favorites, and that was Stratios, where they actually took a lab and it was in Eli Lilly lab based in San Diego, and they did all robotics. And so that was one of the very, very few labs that was open during COVID. And so now Eli Lilly is actually expanding the robotics in their lab throughout the entire United States. And so that we had done a Series B round. It wasn't last money in, they should have a Series C round, but we have been very successful in that space. We had also done Berkeley Lights, that was cell therapy, last money in. So we have done a lot in the intersection, I have to say, of robotics, AI, and healthcare.
Sandra, we should definitely talk because we have a sister accelerator called Hacks, which is hardware. So Opentrons that actually came out of us, and the last year has just been so tremendously a great opportunity for a lot of these fluid handling robotics, as you clearly saw with your success. David, what's your most loved or most hated opportunity right now?
Most hated opportunity right now. I'm gonna give a general answer because this comes from having been on different sides of the table, including starting my career as a lawyer and representing investors in various incarnations, and having been a general partner in a venture fund, having been a CEO and working with investors in a number of stripes. As a general class, it is anything that is Me Too and a fad where there's more that's about sort of fashion and isn't this cool, but when you drill down, it's really hard to understand what differentiates and what the market dynamics are. So I don't like to hate things, but I will shy away from some things that don't make a lot of sense to me, with the perspective of seeing some of these things that everybody has touted as the greatest thing ever, that seems to be more like the Dutch tulip bulb inflation of the 1600s, and some things in crypto strike me as that. But then again, there are some that actually make sense.
I totally agree with you. And I have to highlight that everyone from family office that I've met, very high diplomacy and sophistication, as David is demonstrating. Patrick, what's your most loved or hated opportunity right now?
Yeah. So funny enough, Sandra, we have a very similar approach to our late stage investing as well, pre-IPO stuff. And with that, actually, I'd say our least favorite is crypto and our most favorite is crypto.
Love it.
So similar to what you just mentioned, David, right? Like there's just a lot of fluff out there, and then there's a lot of technology behind other pieces and other coins that are coming out. We just put together like a $30 million investment in Kraken. So, we think the platforms make a lot of sense. We think, just generally speaking, the coins, depending on the backing and what kind of technology is actually like behind the coin itself, is going to make a lot of sense. And then I think there's a lot of mechanics behind getting a lot of that stuff done that is incredibly attractive as well, that we are actually exploring, putting together some like a pool of money to just go after some of that stuff. So I don't mean to not answer your question, but I'm going to not answer your question with the same thing.
I actually completely agree with you, because I think, the fundamentals of blockchain and decentralization as a theme is necessary, right? It's definitely a theme that we can see progressing the next decade. However, there's a lot of fraud in there. Everyone's jumping in, right? And so if you can sift through that fraud to get to that 1%, your returns can be in triple digits. But the question is, how do you avoid the frauds?
Yeah.
Last but not least, Russell, most hated or most loved idea?
Sure, it makes it a little harder after listening to all the good ideas. So
you can go first next time.
So not that it was the was the best deal, but Sandra and I did the same deal together. She introduced me to that. So thank you, Sandra, for that. I hope that's one of many. I would say the following. Generally, what I've found over the last few years, as if I'm looking at the whole private equity spectrum, what's gotten more expensive in relative terms has been the buyouts, the large buyouts, and the multiples. So given my history of being a venture capitalist, what I've done over the last 10 years is really moved more towards the smaller size of venture capital. I do seed and Series A directly. And I think the venture capital has more value these days than the big. I wouldn't say that the larger buyouts are my hated, but I just think the valuation. But in terms of the specific idea, I think, and I have been methodically investing now for 3 or 4 years in blockchain, but on the ventures capital side, building, investing and co-investing in the infrastructure, enterprise software, solving some of the problems, creating some of the rails, creating the pipes for that, because we were very early investors in the internet 20 years ago, and I'm seeing a lot of parallels. So I'm not an engineer. I don't know how to program, but we were fortunate enough 20 odd years ago to figure out that this thing called the internet was really a platform, and people are going to put other things on top of it and take advantage of this platform, and it's going to get massive adaptation. And so we invested, we had technology funds. I'm seeing a very similar thing happening right now. It's called blockchain. In a few years, frankly, people won't know if they're using AI or blockchain. They won't have to, but it's going to disrupt many different verticals. So I am taking a systematic approach, and will continue to do so, investing in globally, not just in the US, but in blockchain venture funds, and also the co-investments in those. And so, I think that's different. There are values in some of the cryptocurrencies. Some, as we all talked about, don't make sense. But I think overall, on the risk-reward ratio, investing in a blockchain with a venture capital approach, I think is frankly the best trend for the next 5 or 10 years, which I'm going to continue to do.
And Gwen, Gwen, I'd like to follow on with Russell's point. So when I talked about direct investing, that was one away from a venture capitalist. But I have to agree with, Patrick and Russell. I also do like blockchain a lot. However, we as a family office don't feel that we can conduct as thorough a due diligence. And so therefore we do rely on our fund managers. And so Brooke Pollock was a speaker of Hut Capital. And I have been tracking him for about 2 years. I liked him so much. I became a venture partner at the firm. I liked what he was doing and the fact that he was seeing what was happening in 10 to 15 of the fund managers, seeing what is working, and then getting co-investment from all those managers. So then he can offer co-investment. So I'm not only a venture partner, but I'm an investor. And that's he offers direct investment along inside his fund along with the funds. I really like that because blockchain is so fast moving, ever growing down the rabbit hole that I have to rely on a fund manager to feel comfortable enough to do a direct investment in that.
And funny enough, we actually just talked about bringing somebody in-house to come manage it for us, right? Like that's how aggressive I think everybody's getting these days. Is like we had somebody come in yesterday and talk to us, and similar to what you just said, which is like if you need somebody dedicated to these resources, because if you don't research, if you're not on the pulse for a week, you're out, right? You no longer know what's going on. And
right.
It's a very interesting aspect of this market that I have no idea about. I don't even pretend. I don't try. And we like you guys, we sort of leave it to the experts, with the exception of the platforms. I've been following Coinbase and Kraken and all the platforms pretty well because the revenues sort of make sense. And that's about it. It's very interesting. It's a very interesting aspect of the market right now.
Patrick,
It's been interesting. It's something that's been interesting, and one of the things that comes with a little bit of gray hair is having seen some evolution of things over time. And what is interesting to me, we've talked about direct investment versus fund investment, and there's been a lot of dynamism. So where I've spent a lot of my career has been on things in the healthcare and med tech space, which has evolved significantly. And I remember when the first of the funds crossed the $100 million mark in Boston, and everybody gasped, and how are you going to have a venture fund this big? And which seems kind of quaint now, but then that ushered in something that fundamentally affected how family offices and other allocators looked at funds, which was as they grew, they got more driven by their management fees than by their aligned interest in a return. And that led a lot of families that had not previously done direct investing to get into direct investing and find that it worked, but with exactly the problem that people have identified here. How do you have the in-house expertise to go at something? But one thing that's been interesting to me to see is how in some of the medtech space, for example, how a lot of the venture funds are going to later points of engagement where the family officers are seeing the opportunity to get in at earlier stages and bringing on much more sophisticated resources. One of the things that the program that Novastone has focused on is it creates some of that kind of leverage, but in the small and medium enterprise acquisition space. It is driven around a search fund type model, but with the centralization of vetting the particular potential candidates or operators through a very steep set of filters, but then also supporting them in parts of the process that are repetitive elements of diligence, transaction execution, and then post-acquisition integration. And in that respect, that's an example because it's not just one family. It had, you know, the Novastone group was the principal sponsor, but then now has about 25 member additional single family offices, and that's growing as part of that program. But what happens is you get the expertise through that program to create just that kind of leverage to be able to identify opportunities in particular verticals that you need somebody who is that expert and is that set of feet on the ground to execute. And so there, you know, just one strategy for having out some management to give the family leverage without necessarily having to build tons of its own staff.
And, you know, David, you bring up a good point. I think, I guess it's been over 20 years now that I sort of went to my first sort of international private equity conference. So there's another element when you're looking for deals and funds or deals that I think is increasingly important. So when I was a venture capitalist, we had our last fund was 185 million, then we did 315 million was growth capital, and as you said, our first fund was 15 million. To give an idea, you know, start out small. People sort of forget that, but
Right.
What's also equally important, and I think sometimes we forget, we do have more information, more data than we used to, but the human connection and having access to the funds or access to the deals is extremely important. I don't think it's that difficult to, I sort of laugh at myself. A friend of mine, another family office, said to me, Russell, we're in the business of missing opportunities.
Mm-hmm.
And it's true because we turn down many more opportunities than we can invest in. And many of them are great deals that we end up not doing. And one hopes that the ones we do or the funds we invest on are good. And that also goes back to having access and having the relationships. And that's why, despite all the increased data and the platform and the technology, fortunately, I think people still matter and that interconnection matters. And that's why we still do this. And I'm looking forward to, I'm actually came up from another family office conference where I'm just participating right now. And I came up to participate on this conference, but it was so nice. It's the first conference today that I've been at physically in the last year. So in Florida, it's open again and people are meeting each other again. And that Zoom is a great tool, it's a complement, but is not, doesn't really take the place of having that physical connection, because over years you get to know people. And I one of the last deals I did recently, a digital fund, and I guess I won't mention it, but it's a well-known one. And I just happened to be very good friends with the founder because he went to Notre Dame when my son went, and we were catching up. And I've known him for sort of 15 years. And he basically said, oh, Russell, we're closing next week. It's oversubscribed, but you know, we've known each other. Can you make the decision in a week? And I said, well, yes, I can. Just tell me a little bit about it. And long story, I did. It was certainly worthwhile, but that never would have come along if I didn't have that personal relationship. So part of the deals is the analysis. And fortunately, I think part of it does go with the relationships, and whether it's gray hair or experience, that gives you access to that. And that's a very important part. And I think I invest internationally as well as domestically. And I would say even internationally is even more important, because it's a Pyrrhic victory. By the time things go wrong or sideways, you lose money. You're not going to hire lawyers and go after someone in a different country where you don't go. It's just crazy. So those personal relationships even mean more, and you have to get to know people. And I think that is as important, because frankly, we miss many opportunities, and there's hundreds, if not thousands, of good funds out there that I'll never invest in, but I want to make sure the ones that I invest in and the deals I do with people, that I get that sense. And fortunately, that's why we continue to do these conferences and get to know people.
Yeah, and it's knowing what you don't know. It's like I tell our principals all the time. I'm like, I don't know enough. Like, you might be interested in it, but I don't know enough about it to feel like I can make a thoughtful and informed decision for you. And so, like, and the way I think about it is always investing with an exit in mind, right? Like, that's always like my constant evaluation is like, okay, that's a great company, I really like it, but should I invest in it? Right? I know it'll grow, but should I invest in it? It's so super interesting that like that's something that you guys also resonates with you guys. I think I try to continue to think about things I don't know more than I can know a lot about nothing, right? Or I can know like a lot about a very particular thing and feel like I can actually make an informed decision about the investment. So anyways.
Both of you actually just mentioned something similar, right? Which is I found that it's not just that every year there's probably a dozen deals that are going to be the unicorns and the winners. So you need to be in at least one or two of those deals, but also when we're looking at specific areas like crypto or medtech, right? The experts are few that really know the technology. So you got to know those experts as well when it comes to diligence, right? And so to Russell's point, knowing the right fund manager, that is part of the diligence for these specialized areas. So totally agree with you on building that network, whether it's founders or diligence. So let's go one more round on, most loved or most hated tech or investment opportunity. We talked about crypto. It's love, hate. Mostly we love medtech and life sciences. Anything else? We'll go reverse order this time. So Russell can go first.
I would say the following. As a class, I've made a large shift in the last 10 or 15 years, and the shifts have been away from two areas. Number one, I've shifted dramatically where I almost have nothing in public equities.
Wow.
And the reason for that is, if you look at the Microsoft or the Google that went public when they did, their valuations, they had so much more juice to grow versus the Coinbase, Airbnb, Uber, where all the juice has been taken already because of subsequent further private rounds.
Yeah.
So my shift is to the point where I have less than 1% in public equities. And people will think, wow, that's crazy. There's still good value. Yes, there are some companies that are still worthwhile, but overall, if you can afford to have the illiquidity, I'm a big proponent of shifting as much as possible out of public equities into private equities. So that's something that's probably a little different, a little contrarian against, and I'll, Gwen, obviously love to hear about you because you said you like private equity, but I think there's a good reason if you look at that. And then the other thing that I've done, and that's not so controversial, but I've done it quite a bit, is I have been investing, and it takes a certain speciality. So I lived in Brazil, I speak Portuguese. So I think that emerging markets make sense. I have a higher percentage of international investments. I would say that almost most family offices based in the US. Now, remember, originally, I shouldn't say originally, but I'm British, but I've spent many years in the States. I've lived in different continents, different countries. But I just think I just invested recently in a Vietnam fund, a buyout fund in Vietnam, investing in Israel. I've invested in India. invested in Latin America. And what I see is there's a lot of great companies, but are they great investments? And if you look at the price multiples, etc., there's a even in the private market, there is also, as the private markets have grown internationally, I'm moving away from, I basically do no longer do US large buyouts.
Yeah.
At all. So I don't do public equity, basically little, and I frankly do not do, even though there's some good returns, the beta is still good, I've moved away from that. So
I actually completely agree with everything that you've said. So I clearly made this shift career-wise, right, from public equities to very early stage venture. And it's just, 10 years ago, companies went public when they were 100 million market cap. Now Uber went public at 70 billion, right? So all that growth is on the private side, no longer on the public side. So if you're only a public investor, you don't get to see any of that growth. And so, and also, not to mention the tax treatment, right? And so for all those reasons, I clearly made a career switch myself. And I totally 100% agree with you on the international aspect. So about a third of our companies are from LATAM, a third are from Europe, and a third are from, Asia, right? And so most of the time we only get one or two companies from the US. And part of it is just because of the valuation that Sandra also talked about earlier, right? And, we really see really good talent, right? Whether it's programming or science, these are international languages, right? And so we don't have to just take US entrepreneurs. And also another point that Sandra mentioned earlier is sort of the barbell strategy, which is actually, so SOSV is one person, right? SOSV owns IndieBio and Hacks and all that stuff. So 80% of the capital is actually reserved for follow-on capital. So the accelerator part is only 20% of the capital, and you're just literally buying for pro rata rights for the winners, right? And so totally agree with Sandra on the barbell strategy as well, and agree with Russell that, later stage buyout, you're just playing on interest rate, right? And where are interest rates going to go? Like, it's worked so far because rates have been coming down, but once rates go up, the multiples may not be going in the same direction anymore. So 100% agree with you. And I would have disagreed with Russell 5 years ago on international because currency hedging is a pain in the butt. However, the other bet is, how long will the US dollar stay the reserve currency, right? And so you actually might be on the right side of the trade to be more diversified currency wise.
It's a long-term trend, right?
Oh, totally. Absolutely agree. So I'll stop agreeing with Russell. Let's go reverse order, Patrick.
Yeah. So funny enough, I was going to say something similar in the sense that, I think from an opportunity perspective, and I'll use two here. The first is, I think late stage, we use a barbell as well. We have a fund of funds on our front end, and that for all the emerging managers. And then we use a lot of direct and co-investments on the back end. And so because of exactly what Russell talked about, which is this, you're missing, companies are just staying private much longer, right? And so you're missing that pop. A lot of times it's in that series C to D or D to E or E to F. You see it go from like $1 billion to $4 billion, right? And people don't really recognize, but that's a 4x return if you get in just before that. Or, in our case, we have investments in just this month, Impossible Foods, Klarna, Kraken, and all of them are expecting to go public in the next 12 to 18 months. And we feel like, we have a $250 million liquid portfolio, public markets. We have a good enough team that'll be able to manage that risk when it gets into the public markets. But so I think late stage investments is a great opportunity. And then I think animal derived food, and I realize this is a little bit of a millennial thing, but from a generational perspective, people are moving away from that part of the industry. And so Just Eat, Oatly, Impossible Foods, Beyond Burger, I think that the growing market share that we're going to see, like meat is a $1.2 trillion industry. And people don't really recognize that, like, we're just sort of scratching the surface of a lot of these different companies. And I don't care if you like it or you don't. There are so many geographically, like there's so many countries like India that don't like basically don't eat meat, right? And still want to be able to access these types of things. So the point is that I think it's a great opportunity for people. I think there's a lot of growth that can still be done. I think they're expecting, almost 10% market share of the, 1.2, $1.4 trillion, depending on what statistics you're talking about. 10% market share of that market, right? That they're going to grow into the alternative meat industry. So anyways, I think if there's ways that you can play the consumer like that, and then I think Russell said on a wider basis, that late stage space, I think is a great way to get access to some of those companies that you don't typically, get those pops from anymore in the public markets.
Patrick, we should also talk because in Dubai we have some of these, like future of food is one of our key areas. We've actually seen a lot of success. So Geltor is one of our companies replacing animal-based gelatin. They actually just they closed 94 million in the middle of a pandemic last year at 400 million valuation. We have Clara Foods, which is replacing eggs. Notco is one of our companies. So they grew too fast, too big outside of Chile. They just landed in the US this year. Memphis Meats, which is, the baby cousin of Impossible.
Very familiar.
They're all our companies. We should definitely talk. So I clearly agree with you on that thesis.
Yeah.
David, most loved or most hated idea, or I guess second most loved.
So there are so many great opportunities now. I mean, so as somebody who's focused heavily on healthcare and med tech, I think there is a time of incredible dynamism driven by the fact that Moore's law and use cases have caught up with things like the ability of consumers actually to use technology as it applies to their health in a way that's not a fad or a fashion. Similarly, the same forces are at work in clinical settings across the board. So some of the areas where 20, 25 years ago, the term digital health hadn't been coined, and really as a thing, healthcare information technology was not a great place to be as an investor. And I think that's really been turned on its head in the sense that there are ways to both access and understand that market as an investor and to benefit from growth trends, and not just in big ticket economies like the US. Getting to one of the themes Russell referred to earlier, investing in Vietnam. I mean, I just cite that as an example. There are a lot of places where applications of technology for healthcare have really been about sort of the first world. And now that's really not the case, because there's a lot of ability to both connect different geographies, connect people, and also play on the interconnectedness of commerce. So that's an area where I think there's going to be extraordinary growth.
Sandra, I'm going to let you have the last word.
Sure. Okay. So my favorite deal is actually the deals that my trusted sources actually show me. So we as a family office like Russell, we are only 2% in Publix. But I've been in venture for 30 years. And what the nice thing about it is that you have trusted sources. And what is happening in this market is something that was old fashioned, and it's like those pledge funds. So, and it's not even a pledge fund. It's actually just some very sophisticated people who have these amazing sources. So I have one very good friend of mine in Los Angeles, and he is friends with many, many different venture capitalists, and the venture capitalists will reach out to him if they actually want to do a follow-on investment. So they'll do a follow-on investment, then they'll contact my friend, and then he will put it out to the family office market. And so there I will pay the 2 and 20 fees, and I'm not actually invested in any venture fund, nor does he have a fund, but he actually is the conduit for this amazing flow. And I know that he has a whole team of due diligence people, and they're looking at the recurring revenue model and the exit opportunities. And so since every single deal that they have shown me is oversubscribed and have worked out, you develop these different different sources. So I have 3 sources that I really trust impeccably. Those are my favorite deals, because, I know where they came from, and I know how much due diligence has been done on them.
Sandra, we're actually coming out with something similar, interestingly enough. It's a really interesting concept, I think, too. Like the pledge fund idea is wonderful, and it works.
It's almost old-fashioned, Patrick. It's going back
really
to what
is
it, right?
Is that right?
Going back to basics.
Exactly.
Right?
Exactly. And so, for us, sometimes, some family offices will, just say, I heard about this deal, and you can get away with paying no fees. But for a very good deal that you probably
Pay
never
the
will
fees.
see, I will pay that
100%.
2 and 20 for
Every time.
sure, to get that deal flow. And so I'd actually emailed me, if anyone wants to compare notes, I am happy to share my sources.
But folks, there's a couple of changes in the pledge fund space in terms of how the fund is constructed for more participation. So I can talk to you guys offline about it, but keep on going. Let's get to closing statements. We've got about 2 minutes left.
Yeah, ladies first. Sandra, closing statements.
So I love the private markets. It is where the growth is. And it really, you're absolutely right. It is situations like this, Marty, where you really get a chance to really hear from other people and, their trusted sources. So thank you for having me. And I'm available if anyone wants to speak to me, but I think the private markets is where it's at. And I'm happy to be 98% in private markets.
David?
I would echo Sandra's comment. I think particularly from the family office's perspective, there's a lot more ability to take advantage of a very dynamic private market setting and eliminate some of the risks associated with needing intermediaries in the public market, and some extrinsic risk that is harder to control than when you're in your own private deals.
Patrick?
Yeah, no, I think just excited to be here. Appreciate everybody's insights and learned a lot. And yeah, if anybody wants to reach out, feel free to ping me. I'm pretty accessible and happy to always talk shop and venture and different deal flow for sure.
And Russell?
So enjoyable. Again, thank you, Marty, for all your efforts. I know it's not easy to put on. Good to see you in Miami last few weeks. Sandra and David, good to see you again. Patrick and Gwen, very nice to meet you. I think, I'm less than 1% in public markets, so I think Sandra and I are very aligned. We invest a lot in blockchain, and we're aligned on that, and we've done a few deals together. I'm sure we'll do many, so looking forward to that, and hopefully we can broaden out with Patrick and David. And Gwen, I like life science, so I'm looking forward to catching up with you on that. I would only say the following. I'm actually indifferent between having a deal brought to me, let's say, there is a strong tendency, I think, for family offices to want to just do the deals and not go through fund managers. And I'll just push back against that a little bit, because it's almost, I'll take the extreme example of the Australian superannuities, who are so fee sensitive that they don't get into the best funds because they're so fee sensitive. So they're cutting off their nose to spite themselves. Same thing in terms of doing deals, with family offices, who they really need to know their verticals and expertise. Or I do a lot of deals through funds that I invest in, and I have co-investments, right? So I don't mind paying fees, And I don't mind if it's with a family office who's knowledgeable, or with a fund who I've known 10 or 15 years, who have a broader team and can help. So it's really, to me, it's all about net profits, net returns, net people, and there's different ways to structure it. And I also, just one last thing, don't be afraid to, my youngest is now going off to university, and she teased me 3 years ago when I bought the book Blockchain Revolution and spent the summer on the beach with writing in it. And she said, whenever I want to sleep, just talk to me about blockchain. And I obviously tease her back now. I said, that book that I read has more than paid for your education. So I say that to her and to all of us. Always be intellectually curious, learn something new. We can learn something new. And right now, for me, the last thing has been the blockchain. Hopefully it's not the last thing I'm going to do in terms of new ideas, but yes, we have our core. We know what we're comfortable, but choose something that you don't know and think about the next 4 or 5 years and start educating it, because every trend, it all started with people knowing very little. So if you can start digging in and thinking about and continuing to do it, that's where you make the real money. You really do.
That's a perfect note to end on. Stay curious, keep learning.